Hey folks, gonna take a look now. Going to take a look at section 179. Now here, notice they use the term immediate expensing. Okay, and it's section 179. So what that allows you to do is instead of taking the asset and taking depreciation, you can immediately expense the asset. Now there are some rules, so there's some limits. There's a property limitation, type of property, and taxable income limitation. So taxable income limitation, they're not going to let you create a loss with this, okay? And you get to choose the assets that you want to immediately expense. Now the purpose of this, the government, by the way, they change this every year. So let's write that down, okay? It changes every year. Bring this over. Changes every year. And basically they look at the economy, what's going on, and they decide each year how much it's going to be. Okay? Now there's also something called bonus depreciation. This is in addition to the section 179 in order to stimulate the economy. That's basically what they're doing. Why would they do that? You can elect out. You don't have to do bonus depreciation, but it depends on the year. By the way, notice here in 2027 there's none. So this all had to do with the Tax Cut and Job Act. This is Tax Cut Job Act in 2017. Okay. And notice, and by the way, so remember I told you some of these things are going away, so you could see. Now, I guess the idea there, they were looking to improve the economy. I guess probably when it came time for, with COVID and all that. But anyway, that's another, it's not section 179, but it's called bonus depreciation. Okay? Now, listed property, this is kind of interesting. This is property that assets that tend to be used for both business and personal use. For example, autos. Okay? So, depreciation is limited to the business use. If you use in business, greater than 50%, you use the normal depreciation method. If it's less, then you use straight line. And if if it changes in the middle, you have to switch methods. Okay? So, here's what happens. So if it drops to less than 50, you have to recompute depreciation expense for all prior years as if it had been using straight line depreciation over ADS recovery period for the entire time. So basically, you have to go back and you have to recompute everything. Okay, and here's the steps below that you have to do it. By the way, to let you know, the software does this for you. You don't have to worry about it. I won't give you a test question on that, but the software does it, frankly. Okay. By the way, here's some limits, depreciation limits on luxury automobiles. Okay. So for year one, and notice if it's placed in service in 2024, $12,400. Okay. And you can also take an additional $8,000 if you're claiming bonus. So now you're at $20,000. Second year. Okay. And by the way, you could see how this has gone up a little bit each year. Okay. So, again, by the way, that's why, I know that sometimes you ran into a little bit of problem with some of the homework problems, but you could see why, because every year these little changes, it's not like regular accounting. So tax textbooks tend to have more errors than any other. Okay. Next thing we're going to take a look at here is amortization. So if you remember, amortization has to do with intangible assets. And these are intangible assets that basically have some sort of fixed life, okay? So some of them are for capitalized research and experimentation, R&E, things like that. So basically it's in one of four categories if you're amortizing it. 197 intangibles, these are purchased intangibles. Startup and organizational costs, research and experimentation costs, and patents and copyrights. Again, because all of these have some sort of either finite life that the law put in place. Well, basically the law put in place all of them. But the reality is they have a finite life. Okay? So for 197, you're like, well, what are those? According these assets, recovery period of 18 months, 15 years, regardless of their actual life. They use a full month convention, allows the taxpayers to deduct an entire month's worth of amortization for the month of the purchase and all subsequent months in the year. Okay, so full month. All right, on that one. What about organizational expenditures and startups, right? This is what it costs to form and organize a business, corporation, or partnership. Startup costs are business cost of business incurred to start up a business. And again, these you can amortize as well. I can't remember. Hang on one second. Be right back. Hi, folks. I just wanted to check on that to make sure. I couldn't remember off the top of my head. And this one is 180 months as well. 15 years. Okay. Now, what about this other one? Research, and again, most of you probably haven't seen these. Research and experimentation. Now, why would the government do this? They have to create innovative products, and to stay competitive, they may immediately expense these costs, or they could capitalize and amortize these for not less than 60 months. Beginning in the month, the benefits are first derived from the research. Okay. So basically the bottom line is here, they can either immediately expense them, or they could do it for a period of not less than 60 months. Beginning in the month, the benefits are first, they can recognize some benefits from the research. By the way, if it's outside the United States, it's 15 years. Okay? So look what this, so obviously they're trying to convince people to do it here in the United States. Patents or copyrights. Here's another one. It depends on whether you purchase the patent or whether you self-create. When you purchase the patent, it's the remaining life. Whatever life for the patent is, whatever that remaining life is, that's what you have. Self-created patents or copyrights, the costs are amortized over the legal life or the remaining useful life. Okay, so again, depending upon which one it is. Okay. By the way, here's the summary of the chart. You know, again, this would be handy to have for a test, I think. 197, straight line, 180 months. When does it start? Okay. Organizational expenditures, 180. When does it start? Okay. First month. And by the way, notice here financial accounting treatment. So, goodwill, trademarks, whatever. Notice here, you check for annual impairment. For financial accounting, you don't amortize it, but for tax, you do. Again, that's going to be one of those temporary differences. Over here, for organizational, you expense it for financial accounting. And for tax, you amortize. Okay, so you see these are the differences. Research, right? Over 5 years, we just mentioned. Financial accounting is expensed. Self-created patent and copyrights, again, 60 months, expensed. Purchased, remaining life, expensed. So you can see there's differences between those two. Finally, we're going to take a look at depletion. This is about natural resources. And basically, companies compute their depletion expense under both the cost and percentage depletion methods, and they deduct the larger of the two. So it's either the actual amount or the actual amount as best they can figure it out, or you have to use this depletion record. And they must estimate the number of units that are in reserve. And by the way, basically you're estimating an inventory. Okay? So once the entire cost is recovered, businesses are not allowed to use cost depletion to determine the annual depletion. So once the entire cost is recovered, you're not allowed to use cost depletion. Okay? And again, the amount of percentage depletion is determined by multiplying the gross income from the resource by a fixed percentage. And we're going to take a look at those percentages. Now, for the life of me, I have no idea how. I don't know. Somebody must have took a look. 5% gravel, 14% for asphalt, rock, and clay. Gold, copper, 15%. Platinum, uranium, titanium, 22%. I don't know. Here's the subsections in the code. I don't know. Hopefully, I guess you could go there and read about it. I have no idea how they developed those. Okay. So here's an example for one. Scrap Happy, they have a tract of forest land they use to harvest trees to produce scrap paper. It's estimated that the tract has 30,000 board feet of timber. The original cost of property is $75,000, of which 60 is allocated to the timber and 15 to the land. Okay, so let's see, what do we do here? All right, what is the cost depletion per board foot? So this is the actual cost. So we got $60,000 divided by 30,000 feet. This is the amount that the trees were worth, is $2 a foot. If the company uses 10,000 board feet during their first year, what will they do? 10,000 feet times $2 a foot, they'll use 20,000. Or you take the $60,000 basis times the resource used equals 20,000 bucks. Okay? And let's see if they had that on. Did they have wood in here? No, they didn't show wood. Wood. Nope, I didn't see wood there. Okay? So I guess wood must be 1/3. Okay? So if the company uses, how much will they expense under the cost depletion method? All right, folks. That's the end of chapter 10. We'll be back with examples in just a little bit.